You're listening to the Capital Stack podcast, brought to you by BWE's Arizona Team, bringing you the latest in capital market and lender news for commercial real estate. I'm Sarah Milley, and I'm filling in for your host, Ryan Denchev. And now for the latest market news for the week of June 13th. Global capital markets continue to hover in a wait-and-see frame of mind, with intraday volatility swings continuing. Very few sectors of financial markets have escaped the choppiness of recent sessions as investors weigh recent guidance and warnings on debilitating inflation levels and the macroeconomic backdrop of central banks' efforts to ease inflation. Convoluting these efforts has been a war in Europe, continued supply chain restrictions on food and energy, and relatively normal demand that is keeping inflation elevated. Central banks are using their favorite tool to combat inflation, higher interest rates. This is to slow economic activity and hopefully reduce demand. There is uncertainty in the market as to whether higher rates will return the desired result and may drive the economy into recession. This concern is heightened considering the Federal Reserve is also planning to sell a portion of its inventory of Treasuries and other securities, which could also push rates higher. Data on May jobs showed that new hiring held at a slower but still robust tempo. Market participants anticipate the FOMC policymakers will keep the expected pace of 50 basis point rate hikes in both the June 15th and July rate decision meetings. The 10-year Treasury yield rose nearly 17.5 basis points from Friday's close to 3.33% on Monday, representing the highest level since May 2011. Now for up-to-date lender news, kicking off with life companies. Life companies executed an impressive number of allocations for the first half of the year by deploying more capital this year to date than in 2021. BWE has been a large contributor to these numbers by providing nearly $4 billion in life company originations year to date. Life companies are winning deals based on their ability to lock in the rate earlier than any other permanent lender in the market. This is a huge competitive advantage during times of rising interest rates, allowing clients to lock a fixed rate as soon as possible. However, headwinds persist as pressure on corporates are causing spreads to widen due to relative value of other asset classes. Life companies will continue to review all deals, but based on these conditions and relatively full pipelines, they may be more deal selective as the year continues. Outlier pricing has widened slightly, but overall spreads for lower leverage deals have held steady at 1.6 to 1.9%. And now, switching over to agencies. The agencies have seen an increase in activity over the past month as both Fannie and Freddie have implemented pricing reductions to their grids. Mission-driven and affordable business will continue to ensure the best pricing. With that said, the second half of the year can open new opportunities for mission-driven or affordable components due to the agencies getting close to meeting their FHFA requirements of 50% of their business being affordable housing. In addition, Fannie Mae has made updates to their underwriting parameters that can have positive impacts to the borrower. With that said, Fannie has recently updated their rental rate growth, allowing for longer interest-only periods by changing how they calculate refinance risk. They have made a meaningful change to this calculation in which they will replace a fixed 2% rent growth with market-specific rent growth data sourced from REIS. What this means is that we are seeing less refinance risk impacting loan sizing, resulting in Fannie Mae's willingness to offer longer interest-only periods on high leverage, low debt service coverage ratio loans. Finally, Fannie Mae recently updated their area median income qualification parameters across the country with more current median family income data from 2020 to 2021. The new AMI table takes this data into account such that MSAs with increased median incomes also saw an increase in the 100% of AMI monthly rent figure. What this means for borrowers is that more of your units may qualify toward Fannie Mae's affordability goals than previously, resulting in better pricing and more favorable loan terms such as increased interest-only periods. And now, shifting to the latest for the U.S. Department of Housing and Urban Development. For new construction and refinance projects located in opportunity zones, HUD provides considerable advantages in processing cost and in-application review timing. To promote opportunity zones, the Department of Housing and Urban Development introduced incentives for property owners applying for certain loans with FHA multifamily mortgage insurance for properties located in qualified opportunity zone census tract. HUD designated specialized senior underwriters in each region of the country to process certain applications for FHA mortgage insurance for properties in qualified opportunity zones. This ensures expert and expedient review of these applications by FHA underwriters. If there is an application queue in the HUD region, the Opportunity Zone projects receive priority expedited processing. HUD also reduced the FHA mortgage insurance application fee for Opportunity Zone applications. For FHA's Section 22D4, Section 220, and Section 223F, mortgage insurance programs for properties located in qualified opportunity zones will be eligible for reduced application fees from 30 basis points of the loan amount to 20 basis points. Rounding out this week's lender news with commercial-backed securities. Commercial-backed security lenders continue to battle choppy market conditions, which have resulted in severe turmoil for their allocations in the second quarter. The market seems to be finding their footing over the past couple of weeks as there has been slight pricing improvements. Spreads for AAA-rated commercial-backed securities spiked to 150 to 155 basis points from 90 to 100 basis points 30 days ago. Although there has been slight improvements in the market and their ability to win business in the past week, it will take time for the market to recover and become competitive. Currently, spreads for lower leverage multifamily deals are seeing pricing around 2.5% over the 10-year swap. Here's your quick market recap. The 10-year Treasury yield rose nearly 17.5 basis points from Friday's close to 3.33% Monday, representing the highest level since May 2011. Life companies are winning deals based on their ability to lock in the rate earlier than any other permanent lender in the market. The agencies have seen an increase in activity over the past month as both Fannie and Freddie have implemented pricing reductions to their grids. Mission-driven and affordable business will continue to ensure the best pricing. Thank you for listening to this week's Capital Stack podcast. For more information on what was discussed during this episode, reach out to BWE's Arizona Team.